Every chart you have ever looked at is telling you only half the story. The candles show where price went, not the force behind the move. That force has a name, and it sits in plain sight, in the row of bars underneath the price. It is called volume. Volume is simply how many shares changed hands, and it is the closest thing a chart has to a lie detector. A move on heavy volume is the crowd shouting with conviction. The very same move on thin volume is barely a whisper, and it usually fails. In the next few minutes you will learn to read those bars, how rising volume confirms a real breakout, how a giant volume spike marks the exact top, how volume going quiet warns you a move is running out of fuel, and how a dead quiet stock is often the calm right before a storm. We will learn it on a clean diagram first, then read it on 3 real stocks. Let us build it from the ground up. Here is the whole idea on one simple diagram: the candles up top and a row of volume bars right below them. Master this picture, and the bars under every chart will start talking to you. First, what is volume, really? Underneath the price, your chart plots one vertical bar for every candle, and each bar simply measures how many shares were traded that day. A tall bar means a lot of shares changed hands, a short bar means very few, and that is the whole secret. Volume is conviction. Look at the tall green bar in the middle. A big price move on a bar like that means the crowd piled in with real money and real urgency. Now look at the tiny bar beside it. That same kind of move on a stub like that means almost nobody took part. It is a move nobody believes in. Price tells you what happened, volume tells you whether to trust it. So here is the first and most important way we use it. Volume confirms. Look at the left of this chart. Price is stuck in a quiet, tight base, going nowhere, and the bars underneath are short. Then price breaks out and pushes higher, and the single question that decides whether that breakout is real is this: did volume expand on the break? See that one huge bar on the breakout candle? A breakout on heavy, rising volume means buyers showed up in force to power price through, and that is a breakout you can trust. A breakout on thin, shrinking volume is a trap with no one behind it, and it usually fails right back into the range. Heavy volume is the green light. The third idea is the mirror of that, and it is your early warning system. Quiet volume warns. Watch what happens here as the trend gets old. Price keeps drifting up, making new highs, but look at the bars underneath. They are shrinking lower and lower, day after day. That tells you fewer and fewer buyers are still willing to chase. The move is running on fumes. When price keeps climbing but volume keeps fading, that disagreement is called a divergence, and it is a warning the trend is tired and a reversal may be near. The fourth idea is the most dramatic of all. A climax reverses. Look at the top of this chart where price has run a long way. Suddenly there is one enormous bar, far bigger than anything around it, a volume climax. This is the moment of maximum greed, where the very last buyers rush in all at once, terrified of missing out. But once that final wave has bought, there is simply nobody left to buy higher, and price collapses. The single biggest volume bar at the end of a long move very often marks the exact top. The same thing happens upside down at a bottom, where panic selling washes out the last seller in a capitulation spike. And the fifth idea is the quiet opposite of the climax. A dry up precedes. Before a big move begins, volume often goes dead silent. Price coils into a tight, sleepy range and the bars shrink to almost nothing. That calm is not weakness. It is a coiled spring. The sellers are exhausted and the stock is winding up. And when volume suddenly explodes back to life out of that quiet, the spring releases and a brand new move is born. So there is the whole foundation. Volume is conviction. It confirms a real breakout. It warns when a move goes quiet, a climax spike marks the turn, and a dry up sets up the next move. Now let us read it on 3 real stocks. Our first example is the single most useful thing volume does. It confirms a breakout, so you know whether to trust it. This is Robinhood over the last few weeks. And notice the chart now has 2 parts, the candles up top and the volume bars along the bottom. We read them together always. Start on the left, in the quiet range. For about 2 weeks, price just drifts sideways, capped under the gold line near 82. But look down at the volume bars underneath. They are short, running below their own average. That tells you almost nobody is trading here. There is no conviction, no urgency. The stock is asleep. And then comes the moment that matters most. On the 28th, price breaks out and blasts straight through 82. And look at that volume bar. It is gigantic, towering over everything before it, nearly double the recent average. That is the confirmation. An enormous volume bar on the breakout candle means buyers showed up in overwhelming force to power price through that ceiling. This is a breakout with real conviction behind it. And here is the part that proves it was the real thing. On the very next day, the volume bar is even bigger, almost triple the average, as price surges again. This matters. The buyers did not show up once and vanish. They kept pressing. Sustained heavy volume right after a breakout tells you the move has real fuel in the tank, not just a one-day pop. And the payoff is right there. Because the breakout came on that big, sustained volume, it was the real thing, not a trap. Price did not fall back into the range. It ran all the way up to 94, far above the old ceiling. So this is your first rule, and write it down: a breakout is only trustworthy when volume expands to confirm it. Heavy bar, real move. Quiet bar, ignore it. Our second example shows the most dramatic signal volume can give you. A climax, the spike that marks the exact top of a move. This is Palantir over the same recent weeks. Same chart layout, candles on top, volume bars below. First, set the scene. Price had been quiet. Then it takes off on a sharp, powerful run, surging higher into the 28th and 29th. Everything looks fantastic. Big green candles, the trend pointing straight up. This is exactly the moment when most people feel safest buying, and that is the trap. Now look at this one bar, and look at the volume underneath it. On the 29th, price spikes up to nearly 158, and the volume bar is enormous, more than twice the average, by far the biggest bar of the entire run. This is a volume climax. And here is what it actually means. This is the moment of maximum greed, where the very last buyers rush in all at once, desperate not to miss out. That giant bar is the sound of the crowd buying the top. Now watch the very next day, because this is the tell. Price does squeeze out one more tiny new high up to about 163. But look at the volume bar under it. It is already smaller. Price went up, but volume went down. That is a divergence, and it is the proof the climax used up the buyers. There was just one last push left, and it came on fading conviction. And then it happens. After that climax and the weak push, the rally dies. Price rolls over and slides all the way back down to 142 over the next couple of days, giving back the entire blow-off. The single biggest volume bar did not signal more upside. It marked the precise top. So here is your second rule: when you see one giant volume spike at the end of a sharp run, do not chase it. That climax is usually the crowd buying the very last share, and it is your warning the move is over. Our third example teaches you that quiet volume is not always a bad thing. Sometimes it is the healthiest sign of all. This is the volume dry up. This is Apple over the last few weeks in a strong, steady uptrend. And this one is all about reading the bars when a trend looks calm. First, look at the price. It is clearly climbing, pushing up to new highs day after day, like that strong green push on the 13th. A powerful uptrend, no question. So far, so simple. Now here is the read most people miss. Look down at the volume bars during this climb. They are quiet, running below average, drying up as price rises. Your instinct might be to call that a warning, but watch the pullbacks specifically every time price dips. Like on the 14th, the volume on that red day is the lightest of all. And that is the key. Light volume on the down days means sellers are not dumping. There is simply no supply, no one rushing for the exit. The dip is just a pause, not a fight. And notice what is missing. There is no climax, no single giant bar towering over the rest, no frantic blow-off spike. Even the quietest bar on the 18th brings no selling with it. So this is a completely different picture from our last example. There, one huge spike marked exhaustion. Here, the calm tells you the opposite: the trend is in control and nobody is fighting it. And the result follows naturally. Because there was no selling pressure to stop it, price simply keeps going, making a fresh new high up at 315. So here is your third rule: do not panic the moment volume goes quiet. Ask what kind of quiet it is. Dropping volume on the pullbacks of a healthy trend means sellers are absent, and that is the calm that lets a trend keep running. Let us lock the whole thing into one checklist you can screenshot and run on any chart. 5 lines. 1. Always read price and volume together. Never trust a candle on its own. Glance down at its volume bar and ask, was there conviction behind this move or not? That one habit changes everything. 2. Confirm the breakout. A break of a level only counts when volume expands above its average to power it through. Heavy bar, real break, quiet bar, fade it. 3. Watch for divergence. When price keeps making new highs but the volume bars keep shrinking, the two disagree, and that is your early warning the trend is running out of buyers. 4. Respect the climax. After a long run, one single volume bar far bigger than the rest is usually the crowd buying the very top or panic selling the very bottom. It marks the turn, so do not chase it. 5. Hunt the dry up. When volume goes dead quiet and price coils tight, do not get bored, get ready. That silence is a coiled spring, and the burst of volume out of it kicks off the next real move. That is it. Read both, confirm, diverge, climax, dry up. Run those 5 checks and the bars under your chart will stop being decoration and start telling you who is really in control. If this made it click, subscribe. We build a new trading skill from the ground up every week. And that is volume. The conviction hiding under every candle, the red that turns a flat chart into a story. Expanding volume confirms a real breakout, shrinking volume warns a move is tiring, a climax spike marks the turn, and quiet volume on the pullbacks keeps a trend healthy. Here is your homework. Open any chart, turn on the volume bars, and find one breakout that came on heavy volume and held. Then find one giant spike at the end of a run, and one steady trend that kept climbing while volume stayed quiet. Do that on 10 charts this week, and you will never look at price the same way again. You will always be asking, where is the conviction? If this gave you a tool you will actually use, subscribe. We build the next skill from the ground up every single week. See you in the next one.